It's no secret that we all want a better rate on our mortgage renewal. I'm going to show you the 4 steps so that you can save thousands on your mortgage in ideally minutes. So the first step is 120 days from your renewal. And you can go on Google, just search 120 days before the date of your renewal. It'll give you the exact window. Reach out to your lender and ask them what your renewal options are. They're going to send out typically a set of options for terms for 1 to 5 years and a variable. You're going to want to take these and figure out which product you want. Step 2, you're going to get an offer from a competitor that's going to offer ideally a better rate and for the term you want. Step 3, you're going to go back to your original lender and you're going to ask them to match or beat it. 85 to 90% of the time, they will be able to match or beat it because they have no cost for you to stay with them, whereas a new lender has cost to take you on as new business. Step 4, you save money. Ideally, this takes about 15 to 20 minutes. If you need help getting that competing offer, send us a message and we can help you out with that. But one thing that's important to know is that if you renew with your existing lender, you do not need to requalify. There's no appraisal, you don't need to make any changes, prove your income or credit. 99% of the time, they don't check any of it. But if you want to add new money, you need to extend your amortization or stretch the loan out to make your payments lower. You need to port the mortgage, or if you're trying to add or remove anyone from the mortgage or the title of the property, you do need to requalify. And all of a sudden the game changes. Lenders go from keeping about 90 to 95% of the business on renewal. The moment you make any of those changes, it's now a refinance or a port, and this requires requalifying. In a scenario where you're requalifying, there's a very good chance that other lenders will be able to provide a better offer. So it can be really worth digging into. But either way, this is a quick tip to make sure that you can save money on your mortgage and get ahead faster. Doesn't require requalifying, and typically speaking, we can get clients that better offer to get their original lender to match in about 10 minutes. So it's pretty quick and can save you a fair bit in the long run. Now, as a little bit of a bonus for you, getting a great rate is obviously important, but it's also important that you make sure you get the right product to match what you're trying to do. So the first thing is, if you think that you may break your mortgage, you're going to want to consider different terms and options. In the scenario where you do not expect to move in the next 5 to 10 years and you don't expect to need any money, it's pretty straightforward. You can take a 5-year variable, 5-year fixed, whatever fits best with your needs based on what's happening with interest rates. But the scenario I really want to highlight is one where you think you may be breaking the mortgage, whether it's moving for work, getting a new home, whatever it may be, needing money to do renovations in your home. This is where we really want to focus on your options. So the first one is a variable product. Typically they come in 3 to 5 years. And the benefit to a variable product is that it provides certainty that when you break the mortgage, you'll pay 3 months interest. So you kind of guarantee if you break the mortgage early in the 3 to 5 years that you're going to pay a penalty. But generally speaking, it's going to be a small one, or the best case scenario. Now, if variables don't work for you, there's 2 real options available. There's short-term fixed, typically 1 to 3 year fixed rate options. The benefit is they do provide a degree of stability. As of today, kind of mid-2023, we're seeing rates are somewhat lower on the fixed side than the variable side, but who knows how things will change. But the big benefit is that you know what your payment will be, and you've taken 1, 2, or 3 years where if you break the mortgage, you're going to pay a penalty. Typically, if you break it really early, you could still pay an interest rate differential penalty, which is one of the larger penalties and what you want to avoid. But as you get closer to your renewal date, typically these penalties roll over to 3 months interest and are very comparable to a variable rate mortgage. Now, if you need a really high degree of certainty and you choose to take a 4 or 5 year fixed mortgage, this is a scenario where you run the risk of having really large penalties. They're interest rate differential penalties, they're called. The challenge is that we don't know what they'll be when you take your mortgage. As interest rates drop from the time you took your mortgage, interest rate differential penalties typically get larger. So the scenario where you locked in at 5% and now everybody's getting 3, that's a scenario where a $500,000 mortgage might have a $60,000 penalty. So you want to be really, really careful with these longer terms if you think you're going to break. But if you have any questions at all, just reach out and let me know. The last scenario I want to touch on is open mortgage options. Now, often people who think they may break their mortgage in the next couple of years think open is a better choice. It can be, but typically only when you're breaking the mortgage in the first 3 to 8 months. What happens is open mortgages have higher interest rates than closed mortgages. Now, a closed mortgage is the options I spoke about earlier, where there's some sort of penalty, 3 months interest or an interest rate differential penalty. An open mortgage has no penalty, but because you have that higher degree of flexibility, it comes at a higher rate. So we have to take a comparison of the higher interest rate you're going to get versus the penalty you're trying to avoid. If, let's say, the penalty you're trying to avoid is $6,000, and the higher interest rate on an open mortgage costs you an extra $1,000 a month versus those closed options with the $6,000 penalty, we know that, hey, if you break your mortgage, you sell your home before 6 months, you'll save a little bit of money. But if you don't sell your home before the 6 months or you change your plan, it's going to be significantly more expensive. The last option is a little bit of a bonus, is you can sometimes go into a home equity line of credit. This caps out at 65% of the value of your property, but often this can be a cheaper option than an open mortgage. So just a few things to consider, but once again, if you need anything at all or you need an offer to get your bank to drop their rates, just shoot us a message and we're here to help.